First, I want to say thank you for everyone joining us today. We really appreciate the time that you took to attend this webinar. I know everybody's very busy, so your attendance is super appreciated. My name is Albert Chung. I'm a principal engineer with GSI, and I'm also a registered CARB lead greenhouse gas auditor. Joining me today on this webinar is Brady Ketting, who's our assurance manager at GSI, and he's also a registered CPA. And I also want to mention, also part of the verification team is Albert Liu, who is also, like me, a CARB accredited lead verifier. The purpose of today's webinar is to really provide, a discussion around what companies should really be thinking about as verification becomes, required element, now for environmental compliance. We'll try to keep this session short and really conversational rather than overly technical, so that we'll leave hopefully some time at the end for some questions and discussion. Before we get started, I want to briefly walk you through the agenda for today's webinar. We'll begin with a short overview of the history and the concept of verification. The goal there really is to show that verification is not, really a new concept. It's been used internationally and within California for many years now, particularly for regulated emission programs. From there, we'll discuss the current state of California Senate Bill 253. As many as you know, there's still a lot of ongoing regulatory and legal activity surrounding the rule. So we'll talk about what companies should really realistically be focused on right now. Next, we'll walk you through the verification process itself. For many attendees, this may be the first time considering a formal assurance engagement. So we really want to explain what us as verifiers typically review, what the process looks like, and some of the common issues that we tend to identify in audits. We'll then spend some time discussing how organizations can really best prepare for verification. This is probably the most practical portion of the presentation because many of the challenges that we see are actually, processes and documentations related rather than actual technical calculation issues. So I think understanding some of our suggestions on how to best prepare will really streamline the process for next year, which goes on to my next point is what you should really be doing this year and next year as assurance requirements and scope 3 expectations continue to evolve. The goal of today's webinar is not to really talk about compliance requirements, specifically like what's required, but really to help organizations, understand how to, really approach verification in a practical and a manageable way, while reducing future compliance risk. Here are a common list of questions that really come up a lot, in companies that we're working for. A lot of organizations are really asking whether they should really voluntarily pursue verification this year, even though limited assurance is not formally required until next year. That's certainly a logical question because verification does require time and resources. At the same time, a lot of companies are realizing that, waiting until 2027 may really mean you're tackling two major exercises at once. Not only are you going through scope 1 and 2 assurance potentially for the first time, and then you're also, if Senate Bill 253 proceeds as it appears to be proceeding, you'll also be having to disclose a scope 3 inventory during that same year. Another major concern we're hearing is around year-to-year variability in emissions, especially if you choose not to get verification this year. Companies really want to understand what happens if their disclosures materially change, just due to comparing, unverified emissions in 2026 and potentially finding, material issues in the audit during 2027. This can potentially draw regulatory and public scrutiny. So many organizations are really trying to determine how to really manage that risk early. We're also seeing concerns around inventory limitation and data gaps. A lot of organizations have been building inventories for sustainability purposes, but not really for regulatory review. And this does cause some anxiety amongst our clients. Questions often arise around whether assumptions and data substitution that have been used historically for years will pass compliance. Another common question is simply how much work is verification and what's involved. Many companies have never gone through a formal assurance process before and really unsure what auditors will look for and what level of effort it will be for your team during that audit. And finally, companies are asking how they can avoid surprises in 2027 when limited assurance and scope 3 requirements are expected to become mandatory. This is really one of the primary goals of today's webinars, is really helping companies understand what verification is, what the common issues are, and what steps can be done now and in the future to make things go smoother. This is just sort of the history of assurance. It's really started developing almost 30 years ago with the development of various frameworks for which greenhouse gases should be, quantified way back in the 1990s. The first time greenhouse gas verification really became required was about 20 years ago through the EU ETS system. Seeing the need to see a developed an international standard verification, ISO soon there followed developing ISO 14064-3, which most verifications are done in accordance to. Following suit with the EU, EPA and more so California developed a mandatory greenhouse gas reporting program, with California passing a cap and trade or cap and invest program, which specifically requires third-party verification on a reasonable level of assurance. This is really the first time greenhouse gases became a regulated entity in the United States. And since then, many third-party assessment frameworks provide incentives or benefits for having its members submit verified greenhouse gas emissions, whether it's CDP, EcoVadis, or even B Corp requirements. Now in present time, the concept of greenhouse gas regulation is becoming more widespread with Senate Bill 253 in California and with a very similar law in New York. And it should be noted that other states, including, such as Washington, Colorado, Illinois, are also considering Senate Bill 253-like regulations. The use of greenhouse verification by regulators is becoming more common. So it's really in your best interest not to view verification as a budget and resource burn, but rather really a chance to improve your publicly disclosed numbers and to really mitigate any risk that comes with compliance. There's various guidance documents out there that really define verification its own way, whether it's CARB, IASB, or ISO. The definition really relies on a systematic and logical approach to reviewing massive amounts of data with a certain degree of audit effort being limited or reasonable assurance. In general, that audit is really an independent review of greenhouse gas related data and really identifying a strategic plan and understanding what data to review and how to review that data. Whether it's a targeted approach, maybe we're looking at 85% of your emissions are bundled into your 4 manufacturing facilities, or maybe a random sampling. You're a 2,000 location bank branch, and we're picking random offices in different states, or maybe it's a combination of the two. The auditor will really have to assess your inventory as a whole to really develop that sampling plan. Once the sampling plan is carried out by the client and the verifier, the client really should be prepared to provide any supporting documentation and assumptions to really support that sampling plan and providing that information to the auditor. And we do want to note, and I think Brady will go over this a bit later, but we do want to note that during the audit, if any material findings do come up, you do have the opportunity to address those issues at that time. Once you resolve those material issues, we then go in and review that it was resolved correctly, so that in the end, the final audited disclosure really should increase the confidence in its accuracy before submitting it to an agency. Currently, the first reporting deadline is expected to be August 10th of this year, which means a lot of companies are already actively preparing their compliance documents. One important point to note is that currently verification is optional for this current year. This has led a lot of companies to ask whether they should, voluntarily do assurance in this year or wait till next year until it's required by CARB. There's certainly not the right answer for every company, but throughout this presentation, we'll discuss some more of the strategic benefits of potentially doing that process a bit earlier in 2026. Initially, Senate Bill 253 is really focused on scope 1 and 2 emissions. For many organizations, that's manageable because they already are tracking their energy usage for a while, whether it's for cost control or facility management. Most companies have a good handle on the data of the energy that they consume. However, even companies already calculating and tracking this energy data, assurance readiness is often a separate challenge. There's also exemptions tied to CARB's December 5th, 2024 enforcement notice for organizations that or not necessarily tracking data needed to calculate greenhouse gas emissions at that time of that notice. For that exemption qualification, we really encourage you to talk to your internal team and potentially with your attorneys to really understand if you qualify, because there is sort of a process for which you do have to submit paperwork and documentation to qualify for that exemption. However, I will warn that, for those claiming exemption, do note that in 2027, next year, you potentially may have to, disclose all at once your scope 1, 2, and 3 greenhouse gas emissions, as well as go through verification for scope 1 and 2. So that's quite a lot for any company in a single year. Beginning in 2027, the current expectation is that limited assurance for scope 1 and 2 emissions will be required, along with, again, like I said, the scope 3 disclosures. For many organizations, that's significantly going to increase the amount of resources for next year. Unlike Senate Bill 261, enforcement has not been paused at this time, as the Ninth Circuit reviews the arguments from January 9th of this year. So organizations should really start preparing as though compliance deadlines will move forward for Senate Bill 253. Generally speaking, I was trying to think of all the clients that we have and, where they fit. And generally speaking, there are three classes of companies who are really having to comply with what's happening in California. First, there are companies with a very mature sustainability program. They've been calculating their complete scope 1, 2, and 3 greenhouse gas inventory for many years, and they feel confident in their data and their processes. A lot of them have already gone through verification before and may have greenhouse gas reduction targets. For these companies, complying with Senate Bill 253 is really just an administrative exercise, because you really just want to make sure that you submit it in a way that CARB requests. Their main challenge is really knowing how to comply with a regulation that has not formally been written yet. And there has been limited guidance on how exactly companies are to show compliance. For these companies, I would just recommend just stay registered with a CARB mailing list, stay tuned to those working webinars, and just stay on top of any guidance how hard CARB specifically requires you to submit your information. Then there are those who I call, developing companies. You've been calculating your scope 1 and 2 emissions for a few years now, and maybe even started thinking about your material scope 3 emissions for what's going to happen next year. Those in this category most likely have not gone through verification. So, there may be a lot of historical data gaps and assumptions and processes that, you've just simply been unsure about. For those in this category, you are likely sufficiently prepared to undergo an audit, and would certainly benefit from at least having a light review of your inventory prior to submitting that information publicly to CARB. Going back to one of the questions posed at the beginning of this presentation, is the risk of large year-to-year variances simply due to material errors in the current year submittal. In my experience, anytime there are year-to-year variances in regulated numbers, that certainly increases your compliance risk with that agency. So your risk will certainly be mitigated by conducting assurance for any compliance year. Another reason to consider verification is you may potentially have to be doing, again, your first audit and preparing your scope 3 inventory next year. So by conducting a verification this year, it will certainly ease your resource burden, specifically the time in 2027 in which you'll have to go through verification and potentially submit your scope 3 greenhouse gas inventory to CARB. Then there are your new reporters, many of which intend to file for the exemption this year. But for those new reporters, again, in 1 year, you're really going to have to catch up a lot to those mature companies, which is certainly a big ask, certainly in a single given year. In the first year of ever calculating, considering your carbon footprint, you really have to prepare a compliance-ready scope 1, 2, and 3 greenhouse gas inventory, as well as go through a verification process for scope 1 and 2. This task of, really doing a greenhouse gas inventory and assurance all in 1 year is quite daunting, which is why we recommend, sort of phasing it in so that, potentially for those in the new reporting categories, I would certainly start collecting the data, understanding what data is required, and maybe even start doing a scope 1 and 2 inventory internally so that come next year, you'll be better prepared to comply with all the strict deadlines. The next few slides will go a little more technical into the details of what the auditor looks for. verification plan, and everything that goes around the actual process. So for those slides, I'll hand it over to Brady Kenning.
Thanks, Albert. Yeah, so this is really the meat and potatoes of what I imagine most of you all are looking to get out of this presentation. So for people who haven't gone through the verification process before, I think people have a much more sophisticated vision of what a verification involves than what it really is. I really explain to people our job is to number one, understand the process that you all went through to calculate your emissions, um, line your process up with the existing GHG protocol standard, and then the rest of our procedures are really performing, reperforming your procedures that you did to ensure that the emissions are complete and accurate. Are complete and accurate. That's really that's really in a broad sense the process that we do. So I like to divide the verification up between planning, the verification process itself, and then the completion procedures. So typically, again, and every verifier is different. I can only speak from what we do here at GSI, but typically verifications start off with a kickoff meeting where you will discuss back and forth about where you all are in your inventory preparedness, what major changes has happened over the past year, and once you're done preparing your inventory, you will send to the verifier your inventory detail. So this is usually a summary of all of your emissions broken out by scope. And typically, in addition to scope, it'll be broken out by activity and by site. So think about like, oh, my natural gas emissions for my Maryland warehouse facility or something along those lines. Once our team receives the inventory detail, we'll design our sampling procedures to target balances that are either highly material to your inventory or carry a substantial amount of risk. And I'll go into later kind of how materiality comes into play because a lot of people have questions around that. Once we've targeted the areas that we're going to be testing, we'll send you a data request. Typically, that's requesting for invoices to agree out activity data or obtaining the original reports that you're pulling the data from. So if you're relying on some kind of software, we'll ask to either observe you pulling that report or receive the parameters of that report. Our team will do year-over-year analytics, quarter-over-quarter analytics, try to identify unique changes that may reflect either incomplete data or a misalignment from what we would anticipate. We'll test the emission factors. So we'll go into this with common issues, but making sure that any emission factors that need to be updated from the prior year have been updated and that you're reflecting, your energy mix properly. And we'll make sure that everything's mathematically accurate. Kind of going back to what Albert was mentioning around different stages of development or maturity that companies take. If you're a company that's relying primarily on, a big Excel file, there's a much higher risk that there's, just a calculation error than if you're using some kind of third-party software. But regardless, we'll ensure everything's mathematically accurate and just flowing correctly to get to the final emissions amounts. So once we've gone through this, our verification process, as we find items, I definitely want to emphasize this is a collaborative process. I think some people get nervous that it's like a three strikes you're out kind of policy, or that one error represents like a failure of the verification. That's certainly not the case. Throughout this whole process, we're going back and forth, asking questions, and if errors are found, you all are certainly given the chance to correct those errors and and make adjustments throughout. Understanding that obviously the more errors that we find on our end, typically that leads to more testing just to ensure that there aren't further errors as a result. So once our procedures are complete and we're satisfied that all the adjustments have been made, um, we will kind of perform a complete independent calculation. So using your activity data, we'll make sure that all the amounts add up independently as opposed to relying just on your calculations. We'll aggregate the misstatements. Anything that hasn't been corrected, we'll make sure that it's below a material amount. And then we will draft a verification letter. The verification letter just mostly talks about how we are independent from the preparer. It'll outline in broad terms the procedures we performed, and then it will also lay out the emissions that we have agreed upon for that year. So it's definitely important when your verifier provides you this draft that you agree with the balances that are reflected on this letter, because as you can imagine, it certainly would lead to like an awkward situation if you include your verification letter in a report that discloses different amounts than what are included in that letter. So definitely make sure that you're in agreement with your verifier as to what's disclosed on that letter. And then again, this varies between who you work with, but our team likes to send a summary of our procedures and recommendations. So I think, as I've mentioned before, verification is very much an iterative process. So there may be some items that, while they are not incorrect or they're not errors, our team will usually provide recommendations of ways to improve your process in the future, or ways that you can refine your data, make our jobs easier, which in turn makes your jobs easier. So we'll provide a summary of more in-depth procedures that we perform and recommendations of what you can do for next year. Albert, you can go ahead and go on to the next slide. So common issues that we typically see, I will just stress the overall theme here that I typically get relay to people is, like, to the best of your ability, document and take credit for all of the work that you're putting into your calculations. A lot of times, people are putting in all this work of around reviews and reconciliations and ensuring emission factors are updated. And it's hard for me to, in theory, that would make the verification easier, but if those processes aren't documented, I can't rely on them for my procedures. I have to assume that we're starting from square one. So number one, it's a huge plus if you have an inventory management plan. If you search, this might be coming up later, but if you search for EPA inventory management plan checklist, there's a public checklist that lists all of the items that are recommended to be in your inventory management plan. It's basically a big Word document that says, here's our process for compiling our emissions. Here are the assumptions we made. Here are the individuals that are responsible for whatever data. So that's extremely helpful for me as a verifier, because I don't have to ask you all those questions. It's just in a nice, neat package where I can read on my own time. Lack of centralized support. So as you can imagine, when we make our selections and we come to you asking for invoices, just as a simple example, it's extremely helpful if the inventory preparer already has access to the invoices that are being relied upon. It's a big holdup if I have to ask the person who prepared the inventory, hey, can you give me the natural gas invoices for this site? And then they in turn need to reach out to the plant manager, and the plant manager, who has other job responsibilities and better things to be doing, and he gave you those numbers 6 months ago, where is he going to find the invoices? There's a lot of back and forth, and there's a lot of time delay as a result of having to go back to a site manager or something like that. So if you're collecting invoices throughout the year and you have them in a big folder, that makes our life a lot easier and your life a lot easier. And then not identifying data owners. As you're preparing, you'll rely on system reports. Make sure you are understanding where that data is coming from and, um, you know, who is in charge of that data and making sure it's complete and accurate. That makes our life a lot easier. Methodology issues. Again, I mentioned this, making sure you update relevant emission factors. It's good to update all of your emission factors every year. Typically, there are updates every year, but things like natural gas, like stationary combustion stuff, is less likely to change substantially every year because the makeup of natural gas does not change significantly year over year. But things like your energy mix from your electricity might significantly change every year. So um, make sure you're updating those. Missing category one emissions. So this is referring to scope three, category one, purchases and services, purchase goods and services. Um, a lot of times people will just, for whatever reason, decide that certain categories or certain purchases are not relevant to that category one. So, I mean, really, I suggest looking at your income statement, working with the accounting team to make sure that all of the expenses that are incurred by the company are somewhere in your emissions. Obviously, if it's electricity spend that's already going to be in scope two, you're not going to see it again in scope three, category one. But the laptops you're buying, even software and legal services have an emission factor related to them and should be represented in category one. And then market-based versus location-based in scope two. I hear a lot of confusion around market-based and location-based if you're not extremely familiar with sustainability. And just to give a very, very brief summary, market-based is basically net of any RECs you're purchasing or any financial contracts you have to lower your scope two emissions. And location-based is just taking your area's emission factor and applying that to your electricity usage, regardless of whatever contracts you have. If you are disclosing market-based, so net of RECs and whatnot, you need to disclose your location-based. That's in the standard. So make sure you understand the difference between those two. Typically, those two have different emission factors from each other. And if you have questions, like certainly ask us. We're happy to help. I'll go through these documentation issues really quickly because I know I've been talking for quite a while. But as I mentioned before, if you have an independent reviewer who's checking all these calculations, have them sign and put their name and date on the worksheet so that we can have more confidence in your work as a result. If there's reconciliations performed where you're agreeing out your electricity usage and its cost to a trial balance item, and those two items agree, like make a note in your file that those agreed as of 12/31. This was performed by whoever, because those are great for us. It's great if you're working with a consultant to prepare your inventories. I would say make sure that you have them walk through how they came to their conclusions. A lot of times, a client, I'll ask about the source of, one piece of data, and they really don't have like a full grasp on the amounts they're disclosing. At the end of the day, you need to have ownership over your numbers that you are disclosing publicly. So make sure you have like a good conversation with a third party that's preparing your inventory if you're going that route. And then understand your data sources, again, talking to the data owners and making sure you're confident that it's complete and accurate. So common verification question. So what is materiality? Materiality as a term is just what would a reader of the disclosure determine to be an important amount? So typically this is 5% of total emissions. We'll design our procedures such that all material balances are thoroughly tested, and even amounts below that amount will perform, some form of like sustain or sensitivity analysis to make sure that if it's not underreported and inappropriately below that 5%. What is considered acceptable support? So the gold standard is third-party invoices or reports directly from a third party. That's what we would prefer, or references to widely accepted, publicly available data. So thinking about emission factors, there's plenty of public databases that you can utilize as support. If you are using something like an internal report, things like if you're relying on costs of items, and you're purchasing them by like large amounts, invoices might not be possible. Just make sure that you give proper context to the report that you're relying upon. A lot of times I'll receive an Excel document with no context, and for all I know, the client could have just manually typed in the Excel cells whatever values they felt like that day. So it's really helpful for me if you can provide it came from this system using these parameters. I can't emphasize that enough. Are site visits performed? So I will say it's up to auditor judgment, and it depends on the complexity of your emissions, history of misstatements, distribution of your emissions, and the number of locations. If you have a very energy intensive facility that makes up 95% of your emissions, that would be a good candidate to have a site visit. Conversely, if you're an office building and you have 3 offices and they're all kind of the same amount of emissions and your activity is very straightforward, a site visit might not be appropriate for that. And I would say typically for limited assurance, especially, we're finding that site visits are pretty rare. Can I fail my verification? So a qualified opinion, that's a qualified opinion, so it's an opinion that's qualified, that would be what most people consider failing a verification. Is I would say very rare, and typically only issued if someone were to refuse to correct what we determine to be a material error, or if the data is so confusing that we can't make heads or tails of it, and the client isn't able to, rectify our confusions, or if, there's outright fraud discovered. We like to say like fraud does not have a materiality amount. So if there's some clear intention to mislead, that would also lead to a qualified opinion. But again, extremely rare cases. All those fall under like an extremely tiny percentage of our verifications. What is the difference between limited and reasonable assurance? So it's a difference in the level of our opinion that we express. I like to explain it as limited assurance is us saying we haven't found anything that is incorrect, materially incorrect, and reasonable assurance is a positive statement saying the amounts disclosed are materially correct. It's the difference between we didn't find anything and yes, these numbers are correct. So what that means practically is limited assurance involves less procedures on our end than reasonable assurance. It allows for more soft assumptions on the client's end, and reliance on internal controls. So if you're verifying up to reasonable assurance, it's great to have a separate preparer and a separate reviewer. It's great to have that detailed inventory management plan. A consistent quarter-over-quarter, year-over-year analytics with explanations from you as to what's driving these differences. So those kind of actions are what separates someone who's ready for limited assurance versus reasonable. How to best prepare for your verification. As I mentioned, document your process in an inventory management plan, referring to that EPA guidance. That's a great first resource for people. Centralize your data collection as much as possible, as I mentioned, making sure that, most of the time you can anticipate the kind of questions we're going to be asking. So if you're able to collect that data in advance, that saves everyone a lot of time once the verification starts. Document your assumptions with emphasis on significant assumptions. This is a great point. If you're relying heavily on, for example, like employee commutes, you're relying heavily on some vague source of like people in Arizona typically have a commute of 40 miles. I mean, it's a weird example because employee commute usually isn't a material balance in people's emissions, but that's an example of like, it's a very broad assumption that you're relying upon, that depending on the level of assurance might need to be stress tested. Pre-assurance or external review by a third party in 2026. Albert mentioned this before, that it's good to have a warm-up before you move on to the real deal. There's plenty of clients where we'll do assurance readiness or pre-assurance or whatever you want to call it, where it's basically a dry run, where we can address some major issues so that in the following year when you're required to have a verification letter, things go a lot more smoothly. You'd be shocked the amount of people that don't actually read the standards that they're preparing to. It's really, I don't know if I'm speaking out of turn, but I don't think the GHG protocol and the ISO standards are as dry as one would expect. You could probably get through the GHG protocol in an afternoon, probably the same for ISO, at least the core tenets that are going to make the biggest difference to you. So you can even, it's publicly available standards. You can easily have an AI generate major summaries of certain sections that are relevant to you, and that's a great way to make sure that you're in compliance before a verification. And then understand your organization's limitations to collect data in future years. So a huge piece of reducing your emissions, if that's your goal in the future, is making sure you have the data to make those decisions. Again, this is a common example we see. If you're calculating your scope 3 category 1 purchase goods and services, if you're calculating that based on really broad non-supplier specific emission factors, you're just saying, again, this is just a broad example, like all paper supplies, we're using just a generic paper emissions factor. You're not going to be able to make an impact by switching to a more sustainable supplier because you're still going to be using that generic paper emission factor for the same cost. Or if costs rise, your emissions might actually increase. So, everyone has different data limitations. The more data you're able to effectively use, the easier it is to pull certain levers to make progress on your emissions in the future. So with that, I think I'll turn it over to Albert to lead us on the home stretch.
Good. Thanks, Brady. Yeah, final slide. Just really some thoughts I wanted to have some takeaways from you as you leave this webinar. First, if your company plans to disclose under SB 253 this year and not to verify, I really strongly encourage to do some level of third-party review before submitting your emissions to the state. Having another set of experienced eyes really review your inventory methodology and any assumptions that you have can really significantly reduce your risk and give you confidence going into next year. I think something that's it's never a pleasant feeling is to sort of discover material issues that could have been found in prior years with there was a little more documentation and support in those years. So we certainly, anytime you disclose a public number specific to a state agency, any of the big year-to-year variances are something that we try to avoid. So certainly assess your risk exposure by really not having your emissions at least reviewed for the first year. I also encourage companies to really honestly assess your record keeping and how you document your processes. In many cases, the emission calculations are relatively sound, but support for your assumptions, the activity data, or your methodology for choosing a calculation process may not be organized in a way that's audit ready. So really improving that documentation can really save a substantial amount of time and effort later for you and the auditor. So oftentimes, as Brady was mentioning, is one of the final takeaways of any audit is to suggested future improvements, and oftentimes those suggested improvements are steps that you could adhere to so that the audit next year will certainly be more smooth. So if you choose to not do a review, just have an honest look at how you document things and how you notate things, because at some point those are going to have to be reviewed by an auditor, and so having those ready will certainly help everybody's case. The one thing I do at any webinar or any talk about what's happening in California is it's important to note that the compliance process is still evolving, and this is oftentimes a starting point for a lot of people. We expect additional guidance and clarification and likely continued discussion around implementation of the specific California rules. So I know a lot of people are sort of viewing this year as just like, sort of a step function, like it's just going to happen this year. And, it's sort of like just a big milestone, but it's really just the start of a long journey. So I really think it's in companies' best interest to not sort of push things off and at least having a review or even go through the audit for 2027. Again, perfection is not expected in the first year for any environmental regulation, whether it's land regulations, waste regulations, or non-greenhouse gas regulations. It's going to be choppy at first, and very similarly what I've seen from other compliance programs. It's happening the same for the greenhouse gases. So really establishing a strong and defensible process early on will really make compliance much more easier in the future, so that again, we are just really in that beginning, but sort of keep that thought process in mind as you're developing a system, sort of document and continued compliance. With that, I want to say again, thank you for everyone for attending, and I hope you found the information today helpful in how you comply, whether it's this year or next year. We'd be happy to answer any questions. I think we have about 10 minutes. If there are no questions, certainly I could just go back to the front slide with our email. So feel free to shoot us an email, or if you do have any questions, by all means, we could address those now. So thank you. Sounds good. Well, it doesn't appear to be any questions. So in that case, again, thank you very much. Have a good day, and we'll talk soon.